Most finance videos tell you to invest. None of them tell you exactly what to do on the day your salary lands. This is that video. I'm going to walk you through a 3-step system, step by step, in real numbers, that you can set up this week, not someday, this week. Because the difference between someone who builds wealth on a normal salary and someone who doesn't isn't intelligence. It isn't income. It isn't luck. It's one habit, set up once, running automatically forever. Let's build it. Here's the problem with the way most people handle their salary. Money comes in, life takes it. Repeat. Rent, bills, food, subscriptions you forgot you had, dinners you deserved after a long week. A new thing here, a small upgrade there, and then, at the end of the month, you check what's left to save. Usually not much. Here's what makes this dangerous. It doesn't get better when your salary goes up. Every raise you get, your lifestyle quietly adjusts to match it. Better apartment, newer car, more comfortable everything. It happens so gradually you don't even notice. This is called lifestyle inflation. And it is the single biggest reason people with good salaries end up with almost nothing. The deeper problem is this. A salary only works when you work. The moment you stop, sick, fired, burned out, retired, it stops too. Clean, immediate, final. Assets are different. An asset keeps working when you don't. It doesn't care if you're asleep. It doesn't care if it's a Sunday. It just keeps compounding. The goal of this system is simple. Use your salary to build assets until the assets start doing the heavy lifting. There are only 2 ways to handle a salary. Spend first, save what's left. Or save first, spend what's left. One of them builds wealth. The other one just feels like living. You already know which is which. The question is whether you've actually set up the second one. Most people haven't. Here's how. Step 1. Open a second account. Today. Not tomorrow. Not when you feel more ready. Today. This account is separate from everything. Different bank if possible. No debit card attached. No easy access. The whole point is that getting money out of it requires effort. Name it something that means something to you. Not savings. Not emergency fund. Not rainy day pot. Something that reminds you what it's actually for. Asset account. Freedom fund. Stack. Whatever makes you take it seriously. The name matters more than you think. It changes how you relate to the money inside it. And understand the difference between a savings account and an asset account. A savings account is where money waits. An asset account is where money works. Most savings accounts pay you 1 or 2% interest at best. Inflation runs at 2 to 3%, which means money sitting in a savings account is quietly losing value every single year. An asset account feeds into investments that actually grow. How much goes into this account? The target is 20% of your take-home salary every single month, before anything else. I know, 20% sounds like a lot. If that's not realistic right now, start smaller. 1%, 5%, 10%. The number matters less than the habit, because here's what actually happens when you do this. Your spending adjusts, automatically, every time. You don't notice the money that never hits your main account. Your brain recalibrates to whatever is available. It happens faster than you'd expect. The most important part of step 1 is this. Automate it. Set up an automatic transfer for the day your salary lands. Not a few days later, the same day. Because if the money sits in your account for even 24 hours, it becomes available. And available money gets spent. Remove the decision entirely. Set it once. Let it run. So, now the money is in your asset account. What do you actually do with it? This is where most people freeze. They open an investment app, see 100 options, get overwhelmed, and leave the money sitting there doing nothing. Don't do that. Here's the answer. Keep it simple. A low-cost index fund tracking the S&P 500. That's it. That is the answer for most people starting out. Not individual stocks, not crypto, not whatever is trending on social media this week. Not anything that requires you to be right about the future. Just a fund that buys a small piece of the 500 biggest companies in the world. When they grow, and historically over the long term they do, your investment grows with them. The S&P 500 has returned an average of around 10% per year, historically, not every year. Some years it drops, some years it drops a lot. But over 10, 20, 30 years, the trend is up. and it has been for over a century. You are not trying to time the market. You are not trying to beat the market. You are just buying the market every month, automatically, and leaving it alone. In terms of where to actually do this, look for platforms in your country that offer low-cost index funds, or ETFs. Search for funds that track the S&P 500 or a global index. Look for ones with low annual fees, under 0.5%, ideally under 0.2%. The lower the fee, the more of your money stays working for you. Then set it to invest automatically. Same amount, same day, every month. This is called dollar cost averaging, and it removes emotion from the equation completely. You buy when the market is up. You buy when the market is down. You just keep buying. And the average over time works in your favor. Step 3. Leave it alone. This sounds obvious. It isn't. Because at some point, probably within the first 6 months, your investment account will go down. You'll open the app and see red. And every instinct you have will say, do something, sell, wait for a better time, move it somewhere safer. Don't. Here's the math on why. The biggest gains in the stock market happen in short, unpredictable bursts. If you're not invested during those days because you sold when things looked scary, you miss them. Missing just the 10 best days in the market over 20 years can cut your returns in half. The people who build real wealth from index funds aren't smarter than everyone else. They just don't panic. When the market drops, you keep buying. When it drops further, you keep buying. When everyone around you is panicking, you keep buying. Because when you buy at lower prices, you get more units for the same money. And when the market recovers, which historically it always has, those extra units are worth more. The dip is not the problem. Reacting to it is. Let's put real numbers on this. Say you take home $54,000 a year after tax. That's $4,500 a month. 20% of that is $900. $900 a month into a low-cost S&P 500 index fund. Same day every month. Automatic. Untouched. Here's where that goes. After 5 years, roughly $69,000. After 10 years, roughly $172,000. After 20 years, roughly $650,000. From $900 a month on a normal salary. And that $650,000 at a conservative 4% withdrawal rate generates $26,000 a year passively, every year, without touching the principal. That's over $2,000 a month arriving whether you work or not. You still have your salary, your job hasn't changed, but now there's a second stream. Running quietly in the background, getting stronger every year. That's what this system builds, not overnight, not in a year, but steadily, automatically, compounding, until the day you realize you don't need to rely on one single source of income anymore. 3 steps. That's the whole system. 1. Open a separate account today, name it, make it real. 2. Automate a transfer for payday, 20% before anything else. 3. Invest it in a low-cost S&P 500 index fund. Set it to automatic, leave it alone. No spreadsheet, no financial advisor, no complicated strategy. Just one habit, set up once, running forever. The only mistake you can make with this system is waiting. Every month you don't start is a month of compound interest you never get back. Compound interest doesn't care about your intentions. It only rewards action. So here's what I want you to do right now, not after this video. Right now. Open a new bank account. Separate from everything. Name it something that means something to you. You don't have to put anything in it today. Just open it. Make it real. Because the moment that account exists, the system has started. Everything else is just filling it in. If this gave you something useful, subscribe. Every week on FreedomStack, there's a new story, a new system, a new way of looking at money that nobody taught you in school. See you then.